Or hello and welcome traders. It is October 29th, 2024. It is a Tuesday evening and I have not had a lot of videos out. I actually tried to get a video out last night. I couldn't make it through it. I've had COVID all last week. I've got a lot of coughing that I do, so I can't really talk for more than a few minutes, which should make most of you pretty happy. My guess is I tried to get videos out. I just can't get through them. I'm going to try to get this one out because I really want to share some stuff with you guys about what we're doing in some of the trading. But what I want to spend some time tonight on is talking about how and why we should average down on potentially cash secured or selling puts. And before you get all crazy about it, and you know that's one of my rules is don't average down. And I'll tell you why that is, and I'll also tell you a little bit about the wheel strategy. So for many of you know that there are many things about the wheel that I don't like, at least the way that most people trade it. So I've got a video out there, draws all kinds of good and bad comments called I Hate the Wheel. And there's a reason that I hate the wheel the way most people trade it. And the way most people trade it is they trade crappy stocks. They trade high premium stocks. They sell naked puts on high premium stocks. In most of the time, we're in a bullish market, so they think they're impervious because things don't go down. Even crappy stocks go up. Okay, but the thing I don't like is that when you're trading these crappy stocks, eventually, if the market sells off and they go down, you're going to get assigned. You don't get assigned on stocks that are strong and moving higher. You get assigned on stocks that are moving significantly lower, okay? Which means A, you're getting stuck with potentially a dog, okay? Unless it was the whole market that was moving down, number one. And then number two, you're trying to wheel out of that by selling calls. And if you do get assigned, you're selling calls and limiting your potential upside. Okay? So if you get assigned, it's in a stock that's going down, and B, if it's trying to go back up, you're going to limit the upside, okay, where maybe you break even or you generate a little bit of money. And I just don't love the overall view. However, what I do like about the wheel, and my favorite thing about the wheel, which I do like, okay, is if you do this on long-term great companies, it can be an effective strategy. I'm talking the Apples, the Amazons, the Googles, the Nvidias, the I don't know if I even want to put Tesla in there, the JP Morgans of the world, the Berkshire Hathaways of the world, the really great stocks out there. If you do this in those quality companies, things can really pay off. Okay. And I think it's a great strategy to sell naked puts and sell leaps potentially in these companies, because the leaps, in my opinion, are a great way to generate good cash flow and potentially get into a stock that's a quality stock at potentially a lower price, if that should even happen. Okay. And most of you say, oh, I'm okay owning that stock. Are you really okay owning that stock? Okay. So one of my trading rules is never average down. I don't like averaging down because averaging down means I'm taking a loser and I'm buying more of a loser, more of a loser, more of a loser. And now I've got a whole lot of loserness. Okay. I've got a whole lot of stock, okay, in something, or a whole lot of options in something that's typically just going down, which is a loser. Okay. Your stock is a loser if it keeps going down further and further. However, there are exceptions to every rule. So let me talk a little bit about why averaging down can be strategic. Okay, number one, and there's really only 4 reasons I can think of that averaging down would be acceptable. Number one, it's in a high quality stock. Okay. In fact, we can strip this down to that one alone and just say, if the stock's a high quality stock with strong fundamentals and a track record of recovering from dips, then averaging down could reduce your cost basis and make it a more effective trade. Okay. And what are we looking at? How are we defining high quality stocks? Stocks that I want to trade, number one, consistent earnings per share increases, consistent revenue increases, low debt to no debt, okay, and then potentially strong cash flow. And even I like, reinvestment in technology, reinvestment in the company I don't like dividends. Okay. Oh, now I'm going to get all the dividend haters out there. I hate dividends. Okay. That means a company is taking its hard-earned great cash, and instead of reinvesting it back in the company to make it even better, we're giving it away to shareholders so that we can get listed in some ETF somewhere. Okay. Stop doing that. Okay. Buy back your shares, make the float smaller, push the price up, make it a more effective stock. Okay. Reinvest that money in technology, in AI, in whatever you need to. Okay. Buy Bitcoin with it, like Michael Saylor's doing over at MicroStrategy. Okay. Invest that money into something positive as opposed to just giving it away to people. Right. So anyway, I want those types of companies, strong, high quality stocks. Right. Another reason would be potentially in companies that have a long-term bullish outlook. So maybe I have a long-term bullish outlook on a stock that maybe it's not as good a quality. And a good category here would be like a Palantir, okay, which has been a terrible stock for years. Okay. All of a sudden now it's a great stock and everyone wants to own it. SoFi, terrible stock for years. All of a sudden now it's moving up and everybody wants to deal with it. Otherwise, most of you have been selling SoFi puts and getting assigned and assigned and assigned until you have 8 million shares, okay, because the stock just keeps going down. Okay, lots of dogs out there. Okay, some of these will turn into be princesses, okay, down the road. Okay, but some of these are just dogs. And let's take a look at some examples of these in just a minute. Okay, but what are some of the pros and cons of averaging down on quality stocks? Number one, you can lower your cost basis. So if executed correctly, averaging down can reduce your effective purchase price. It's going to be beneficial if you're ultimately assigned those shares. Number two, you get more premium income, so you can generate more income on the way down. Maybe you're doing this in stages. Again, you got to be careful not to spend too much money of your buying power on one stock. But if you've got a good quality stock, it's okay to potentially average down and generate more income from that. Okay. And then the third piece here, pro, is we have good potential for recovery. As a stock recovers, now we can have different stages that we're getting out because we've been assigned on the way down and we get out on the way up in stages. So we're generating more cash flow. What are some of the cons of averaging down? Well, number one, you're going to hold the declining asset potentially. This is why I hate most of these. And I'm going to give you examples of these. And we're going to pull out a lot of companies that look terrible, okay, that people wheel all of the time. Okay? I don't want to hold the declining asset. I want stuff that's going up. Okay. So if the stock keeps falling, you may end up with multiple assignments on varying prices, increasing your exposure to a potentially poor investment, which is my number one reason that I don't like to wheel the way most people do it. Number two, you tie up a lot of capital. If you're averaging down, you're using more cash reserves, more of your margin, you're tying up capital that you could be putting into other trades that are going up. Okay, that's a different direction, but what have you. Okay, and then the last piece here is you are increasing your risk exposure to having a single stock, which can potentially be detrimental in the long run if you own too much of the same stock. That could be detrimental to you. You know, I'm not a big fan of diversification. I agree with Warren Buffett. Okay, when it comes to diversification, I think it's a tool of ignorance to try to be over diversified a bit. Understand the companies you're trading, get into great companies, and you don't need to be diversified. And personally, I love just being in the S&P 500, maybe the QQQs, and really, or even IWM, the small caps, and that's really it. You don't have to do all of these 150 different stocks in your portfolio. You can pick key stocks, key ETFs, or indexes and do really, really great. Okay. However, you're not going to do that. Most of you are going to go out there. You're going to watch a bunch of people wheeling all over the internet. Okay. And you're going to get into some of these stocks. Let's take a look at some of these things now. Okay. Let's take a look at Dollar Tree. Okay. Dollar Tree, if you were selling puts at 130, you're getting assigned. Then 120, you're getting assigned. 100, you're getting assigned 80. Okay, this thing has dropped over the last 2 years alone. Dollar Tree's dropped from 160 to 60. Okay, great company. Okay, now, would this be something that you would wheel? Some of you do, some of you don't. Okay, but if we take a quick look at it, does this look like a steady increase of revenue and net income? No, you got flat, low net, good revenue, bad net income, then revenue's dropping the last couple. This is not stable. Cash flow, negative, oh, positive, oh, negative, negative cash flow. This is just not a great company. Stay away from that type of a company. Right? Let's look at some other examples out there, and let's look at PayPal. Okay, PayPal. Look at this thing. It's dropped from, well, we even way back here at the 200s all the way down to like 80. Okay, well, it's coming back though. It's coming back. Look, it's gone from 60 to 80. Okay, meanwhile, that's what everyone will tell me is it's gone from 60 to 80, but they didn't tell me that they owned it at 200 out there. So again, another company where you're stuck in holding a declining asset. How are PayPal earnings? Just take a look. It's not consistent. Revenue's up, revenue's down. Revenue's up, revenue's down. Earnings are up, earnings are down. How's the cash flow? Okay, see for yourself. Let's take a look. Okay, here's PayPal. Look at these earnings. Rising revenues and earnings, and then boom, revenues dropping, earnings dropping, revenues and earnings trying to come back. Okay, and then cash flow, negative, oh, positive, doing great, oh, not doing so, oh, now this negative cash flow again, just terrible. Okay, research the companies that you're trading. If you don't see consistent cash flow increases and positive, stay away. If you don't see consistent annual revenue and net income increasing, stay away. Okay. What's another stock? I'm not going to go through. I could go through hundreds of these things with everybody. Neo was one people loved to do. Neo's dropped from 40 down to 5. Intel. Okay, there's another one. Okay, this thing's been 55, dropped to 25, cut in half, ran back to 50, and now it's back down to 20. Okay, Intel, not great. Okay, this is not a company that you want to be in. Okay, why wheel it? Well, it's a popular name. People want to be in it. Semiconductors, they're great. Okay, go look at the quarterly earnings. Okay, increasing revenues, decreasing revenues, and net earnings per share, negative now. And if we look at the cash flow, okay, our first positive cash flow in a year just happened. Okay, that is not a company that I want to be engaged in. Okay, so you really got to pick Mara. Oh, love these things. Okay, Mara, yeah, went from 80, okay, down here to 5, ran back up to 30. Everybody thought this thing was going great. Okay, and if you got back in around the 30, 25 level, you're back in the teens. Okay, not a company, again, that's going to give you solid long-term. Excuse me. And if I'm looking at, and how could you have avoided that? Well, maybe just simply, and this is just Google finance. I'm not trying to do anything crazy here. Okay. Look at revenue increasing, earnings increasing, revenue decreasing, earnings decreasing. Okay. This is not, it was looking okay. Didn't bang. Okay. Mara, not great. Do we look at the cash flow? Positive, negative, big positive, negative, bigger negative. Okay. Terrible cash flow. Okay. But yet people want to wheel Mara. Well, Mara has been going from 30 down to 15. Well, now it's from 15 up to 18. Okay. You can find an exception to everything that's out there. Okay. You can all prove me wrong on this, but what I'm telling you is there are times when it is okay, in my opinion, to average down. Okay. So averaging down can be done, and it can be done usefully. Okay. in many different areas here. I don't like to average down unless the company is super strong and has had a track record over the last 10, 15, 20 years of handling sell-offs. 2008, how did they do? COVID, how did it do? 2022 bear market, how did it do? Has it recovered? Does it take a dip and then comes right back and continue to plow forward? This is what we're looking for. Okay, so bottom line, it's okay, to average down, and it can be strategic at times. Right now, I've got multiple naked puts in bonds. I've layered down a bit. There are different levels. Bonds have been falling. Totally fine. Are bonds in a poor quality holding? No, they're backed by the U.S. government. No comments necessary about the U.S. government and how poorly managed it is. However, bonds are considered fairly safe and fairly strong. They go through cyclical up and downs. The Fed's cutting rates. Bonds got a little ahead of themselves. They've started to tail back off. We're starting to layer back in as they come back down. And then as the Fed continues to cut, and potentially if we head into any kind of a recession or something next year, and bonds start to spark some interest again, China economy gets stimulated, they want to start to rebuy U.S. Treasury again, you're going to see the price of bonds start to rise. And as you've averaged down potentially in quality underlyings, like those high quality stocks or the S&P or potentially bonds or something like that, in the long run, those will pay off for you. Doesn't mean it's going to pay off in 2 weeks, 3 weeks, but there are times when averaging down can be strategic. All right, if this was helpful to you, click the like button down below. If you're not a subscriber to the channel, feel free to do so. We'd love to have you on board. Lots of great training stuff coming out. And if you want to see what I'm trading and how I'm trading, we had a great day today in the markets. Come and join us over in the Discord. We'll see you later. Everybody stay safe. Take care. Bye-bye.